You trade your time for a salary. The exact second you earn that paycheck, the government steps in and extracts its maximum percentage. So you take the heavily taxed leftovers and try to build wealth. Maybe you put it in a normal checking account, or you aggressively day trade stocks. But every time you buy, sell, or earn a dividend, you trigger another taxable event, stripping away your future growth piece by piece. People love to complain that this system is rigged against them by some shadowy conspiracy. It isn't. The financial system simply has strict written rules that heavily penalize anyone trading time for wages. This flowchart breaks down exactly how that penalty works. Most laborers operate entirely in the red income layer up top, where every dollar you move is blocked by toll gates. Wealthy individuals live on the unobstructed path below, the asset layer. To stop hemorrhaging money, you have to stop playing by the rules of an employee. You need to structure where your money sits and when it moves, exactly like an elite owner. Escaping the middle-class trap requires completely redesigning your financial architecture. It means changing how your capital is acquired, how long it stays put, and how you pull it out. This animated diagram compares your two options for earning. On the left is the employee's tax then spend funnel. On the right, the owner's spend then tax funnel. By structuring as a business, you intercept capital before taxes. Instead of taking cash, a business spends money on tools, software, and travel first. These expenses pass through the funnel, legally reducing your taxable base, leaving a smaller target for the government. Smart owners also look at their corporate jobs differently. They aggressively route their compensation into employee stock purchase plans and equity benefits to capture raw capital with built-in tax advantages from day one. They also physically separate where they earn from where they live through geographic arbitrage. Rent, food, and services scale with your location, not your salary. If you live somewhere quiet and affordable while reeling in your high income from an expensive tech hub, you instantly lower your burn rate. Your income travels, your lifestyle follows, and you create massive breathing room. By restructuring your income streams and your physical location, you maximize the amount of raw pre-tax capital you retain inside your system to be invested. Once you secure that raw capital, the absolute rule of the financial system takes over. The math heavily rewards money that stays stationary. Routing those funds directly into tax-advantaged accounts means the money grows for years before taxes ever touch it. It compounds entirely shielded from the continuous friction of annual tax bites. This line graph illustrates the mathematical cost of constant trading. The jagged line loses vertical height every time you buy and sell because you trigger a taxable event. By holding index funds instead, you experience lower turnover and trace the smooth, unbroken curve of exponential growth. This bar chart demonstrates another structural edge: real estate depreciation. The green bar shows your positive, profitable monthly cash flow steadily rising, but because the tax code assumes your building is wearing out, you write off a paper loss. Your red taxable profit artificially drops to zero. Governments wrote this legal write-off into the system to intentionally incentivize property development. True compounding can only do the heavy lifting when your capital is thoroughly protected from the systematic drag of tax extraction events. As your money grows and your portfolio expands, your exposure to risk grows right alongside it. A large pile of personal wealth automatically attracts business disputes and greedy lawsuits. Holding everything in your own name means one bad lawsuit can wipe out your life's work. Asset protection wrappers, like LLCs and holding companies, create a strict legal firewall between your personal vulnerability and your business wealth. Look at this animated diagram. In the center is a massive compounding asset. Most people think they have to sell it to get cash, which triggers a tax bill. The elite use buy, borrow, die, drawing untaxed liquid cash directly from the asset. Using a home equity line or securities-backed line, you simply use the asset as collateral. You aren't liquidating. You cleanly unlock liquidity without a taxable sale. The underlying asset stays right where it is. It continues to grow and compound untouched, often at a rate that outpaces the interest on the loan you just took. Substituting debt for income is the ultimate mechanical solution. It allows you to spend your wealth freely without ever stepping back into the heavily penalized income layer. You have successfully transformed from a heavily taxed laborer into an insulated owner. Your wealth is structurally protected, far out of reach from the extraction mechanisms constantly snapping aggressively around the perimeter. Despite all these complex legal structures and carefully planned entities, the single most powerful loophole written into the financial code is simply patience. Taxes apply when you actually sell an investment, not while it sits there growing. By flatly refusing to sell, you interrupt the government's ability to tax your growth. You gain total strategic control over the exact timing of your tax bill. While the middle class loudly complains that these rules are unfair, the elite quietly adapt to the underlying mathematics of the system. Building generational dynasties has nothing to do with working harder. It requires definitively migrating your entire financial life away from the employee rulebook and permanently establishing yourself in the asset layer. It is time to upgrade your financial architecture. Stop leaving your money exposed on the table and start seeking out the specialized mentors who can help you execute these